You are looking at a screen, let's talk about it, of Apollo. Apollo seeing a rare setback, taking a loss on a portion of $170 million asset-backed financing for an Amazon brand aggregator Perch that was written off to zero. That loss represents about $500 million commitment. Joining us now is Bloomberg senior reporter Silas Brown. Silas, ultimately, these are the kind of figures that I guess are like a drop in the bucket for Apollo. So what's more important, the loss itself or the fact it was a loss for ABF, something that has been billed as very safe?
Yeah, I think it's the latter. I mean, I think the way that I see this story is that it's a kind of shot across the bows for an area of private credit that was seen as the kind of great, sort of success story, and this kind of like great kind of area of scale for the market, and crucially a way for insurance companies to put their balance sheet to work in the industry. And I think this is a kind of rare blemish and somewhat of an interesting phenomena, because the way that asset-backed credit is structured normally really mitigates against the risk of loss. So as you say, I think it's a kind of important, it's an important sign.
Well, can we just talk about the structure of this itself? Wasn't it highly complicated and structured in exactly the way that you're talking about, Silas? How does it record such a loss when it is built in a way to try to mitigate these risks?
Yeah, I was dreading the question of how it was structured because it's very immensely complicated. But I think the essential point is that the way that these kind of transactions work is they're intended to be like substantially less risky than the, I guess, like direct exposure to inverted commas private credit. And so how they do that is keep the investment somewhat, one step removed from the actual loan, the actual exposure, by structuring it to make it kind of more senior to the underlying lending. And I mean, that is an enormously successful trade, and I think a lot of insurers' balance sheets are kind of being funneled into these types of investments. But as I say, I mean, it's kind of a fallible thing, and as this story demonstrates, it's a kind of warning shot for the industry.
Silas, I want to ask about the CVC deal for Marathon Asset Management, because it struck me as a low price considering the assets under management at Marathon, well over $20 billion, and the price tag of $1.2 billion, with a third of it apparently going to Blackstone investors. Seems like a real discount. Why?
That's so interesting that you say that, because, by the way, I should caveat this point by saying I am by no means in any way an M&A analyst. But what I would say is it's interesting you say that, because I've had actually people saying it was kind of overvalued and people saying it was undervalued, and then some people saying that it was kind of just about right, which I suppose is kind of the nature of things. I would say, look, I mean, I think Marathon has been fortunate in that they've kind of found themselves in this position of strength as a somewhat independent. I mean, I know that Blackstone had a stake, kind of arguably a global manager, definitely strong penetration in the US, to these kind of like buzzy forms of leverage credit. And so, I mean, in this kind of quest of the larger private capital managers to kind of scale and develop these multi-product offering machines like Blackstone and Apollo, but also CVC notably, I thought Marathon and Bruce Richards and the kind of team there have been beneficiaries of that trajectory.